Where a liability sits on your balance sheet matters more than most people realize. In this section, we are going to walk through the rules for classifying liabilities as current or non-current, and show you exactly where misclassifications happen and why they cost companies in audits. Here is what you will be able to do by the end of this section. You will apply the 12-month rule with confidence to any liability you encounter. You will know which liabilities are always current without any analysis needed. You will recognize the triggers that force long-term debt into the current bucket. You will explain when and how the refinancing exception saves a liability from being current. And you will spot the key difference between GAAP and IFRS when a covenant is violated. Here is the key thing. This is not just a bookkeeping exercise. Where you put a liability on the balance sheet directly moves your current ratio and your working capital. These are the two numbers lenders look at first when deciding whether to extend credit. Investors use them to gauge whether a company can meet its near-term obligations. If you misclassify a liability, even unintentionally, you are giving stakeholders a distorted picture of liquidity. And auditors know this, which is exactly why it shows up as a finding so often. Most people assume there is a complicated test here, but the general rule is actually straightforward. A liability is current if it is expected to require the use of current assets or create new current liabilities within 12 months of the balance sheet date. The only wrinkle is the operating cycle. If your business cycle runs longer than 12 months, you use that longer period instead. This exception matters in industries like construction or agriculture. For most companies, 12 months is the line. You apply this test at every period end, not just once when the liability is first recorded. Watch out for this one. Some liabilities never need analysis because their nature makes them current by definition. Accounts payable are always current. Trade obligations settle within the normal operating cycle. Accrued liabilities like wages, rent, and interest are expected to be paid within 12 months, so they land in current too. The trickiest one here is the current portion of long-term debt. At every period end close, you must pull forward the principal amount due within the next 12 months and reclassify it as current. Skipping this step is one of the most common audit findings in practice. This is where things get interesting because the mechanics are simple but the failure rate is high. At every period end, you identify the principal amount of long-term debt due within the next 12 months, then debit long-term debt and credit current portion of long-term debt for that same amount. The entry moves the obligation from non-current to current where it belongs. If you skip this, non-current liabilities are overstated and current liabilities are understated. That means your current ratio looks better than it actually is, and auditors will catch it. The surprising part is how often companies treat long-term debt as a single line item when it almost always needs to be split. The portion of principal not due within 12 months stays non-current. That is straightforward. But a 5-year term loan, for example, will have a current portion every single reporting period as the next year of principal comes due. The balance sheet should reflect the actual repayment timeline, not just the original loan structure. Every quarter or year-end, you reassess and reclassify as the maturity date moves closer. Here is the key thing about covenant violations. The moment a lender has the right to call the debt early, that debt is no longer long-term from a balance sheet perspective. If your company violates a debt covenant and the lender can accelerate repayment, you must reclassify that debt as current. The only escape is obtaining a valid waiver before the financial statements are issued. And here is what trips people up. The waiver must be in place before the issuance date under GAAP. Intent alone is not enough. If no waiver exists at issuance, the debt is current, period. Most people assume GAAP and IFRS align on covenant waivers, but they do not. Under US GAAP, a waiver obtained after the balance sheet date, but before the financial statements are issued is enough to keep the debt non-current. Under IFRS, you need the waiver in place by the balance sheet date itself. The later issuance date does not help you. This means the same covenant violation with the same waiver obtained in, say, February could produce different balance sheet classifications depending on which framework you are under. For companies reporting globally, this distinction is critical to get right. The refinancing exception is one that catches a lot of people off guard. If you have short-term debt that would normally be current, you may be able to classify it as non-current, but only if two conditions are both satisfied. First, you must intend to refinance the debt on a long-term basis. Second, you must have the ability to do so, meaning a binding long-term refinancing agreement must already be in place before the financial statements are issued. Intent without a binding agreement is not enough. If the agreement is not signed before issuance, the debt is current, regardless of what you plan to do with it. Deferred revenue does not fit neatly into always current or always non-current. It depends entirely on when the performance obligation will be satisfied. If a customer prepays for a subscription covering the next 12 months, that deferred revenue is current. If they prepay for 3 years upfront, you split the liability. The first 12 months goes to current, and the remaining balance stays non-current. The split needs to be updated at every balance sheet date as time passes and obligations are satisfied. This is especially important for software companies and any business with annual or multi-year subscription models. Let us bring it all together. The 12-month rule is your foundation for every classification decision. Reclassifying the current portion of long-term debt is not optional. It must happen at every period-end close, and missing it is a top audit finding. Covenant violations push debt to current unless you have a binding waiver in hand before issuance under GAAP, or before the balance sheet date under IFRS. The refinancing exception only works if you have both intent and a signed agreement before the statements go out. Get these right, and your balance sheet will reflect a true and accurate picture of your obligations. Thank you for completing this section on current versus non-current classification. Thank you for watching. Subscribe for more training from PNJ Group.